This phenomenon marks the precise moment when the supply and demand dynamics, which fueled the rally, shift decisively in favor of the professional operators. It is the signature footprint of the composite operator preparing for a major reversal, utilizing high volume to secretly transition their position. Recognizing this chart pattern allows traders to exit dangerous positions before the inevitable collapse or major markdown begins. Before we delve into the mechanics of this market killer, please take a moment to subscribe to the channel right now. A simple click and a quick comment, even just a single word, helps the algorithm tremendously in recommending this essential market education to more people. This feedback shows me that this kind of detailed analysis truly matters to you and is worth the extensive effort of creation. Furthermore, remember this channel is a resource to return to during challenging market times, especially when trading becomes difficult and your confidence starts to waver. The wall of absorption represents a profound paradox that defines the end of a sustainable move. It highlights a massive expenditure of effort by the market. Yet this effort yields virtually no measurable result in price progression. The thesis is simple. When institutional money pours in, but the price refuses to move, it signifies that equally powerful money is meeting it precisely at that level. This standoff, where volume is high but price spread is narrow, is the telltale sign of trend exhaustion engineered by those who control the market's flow. Richard Wyckoff structured his entire methodology around three fundamental laws, with the second law being the most crucial for understanding absorption. Wyckoff's law of effort versus result states that the magnitude of a price change must be reasonably proportional to the volume traded during that period. In a healthy uptrend, high volume on a specific day should logically result in a wide price spread and a strong close, indicating demand is easily overcoming supply. Conversely, low volume should produce only a small price change, confirming apathy or minimal interest. The wall of absorption is the systematic, unmistakable failure of this essential law to hold true. It is the moment when the market expends maximum effort, evidenced by volume spikes that dwarf prior averages, yet achieves minimum result. The price action stalls completely, often closing near the middle of a very tight daily or weekly range. This disconnect reveals that the professional money, the composite operator, is actively engaged in a massive transfer of ownership. In the case of an uptrend nearing its end, high volume is still present because strong demand is continually entering the market, trying to push the trend higher. However, this demand is being silently and systematically absorbed by the composite operator, who is meeting every single incoming buy order with a corresponding sell order. The absorption process is deliberately designed to offload large positions without triggering a panicked markdown that would reduce the profitability of their distribution campaign. The price cannot advance because the supply is perfectly calibrated to match the demand at that specific price ceiling. This careful balancing act creates the visual characteristic of the wall, a cluster of high-volume bars that seem stuck in place. The composite operator understands that a sudden, sharp price drop would alert the public and prematurely end their distribution. Therefore, they must allow the price to hover near the highs, soaking up the remaining retail enthusiasm and institutional follow-through buying. This prolonged period of intense, high-volume trading near the peak is the definition of the absorption zone. We must recognize that the composite operator's actions are always deliberate and well-planned, rarely accidental. Absorption is not just random institutional trading. It is a calculated campaign to liquidate assets into the strength of the market. They use the remaining momentum of the trend to their advantage, ensuring that every share they wish to sell finds a willing buyer. This process guarantees maximum liquidity for their enormous selling campaign. When Wyckoff observed this failure of the law of effort versus result, he immediately understood that the character of the market had fundamentally changed. The trend was no longer driven by genuine, uninhibited demand. It was being artificially sustained by a professional counterforce. This insight is the key that unlocks the intentions of the biggest players on Wall Street. The presence of the wall of absorption is a flashing red light, signifying that the smart money is leaving the party. The volume itself is a critical component, serving as the effort metric that must be compared to the price spread, the result metric. If volume suddenly triples but the daily price range halves, the effort is producing a negative result relative to expectations. This discrepancy is the quantitative proof that supply is now overwhelming demand, even if the price has not yet broken down. Understanding this ratio is fundamental to Wyckoff's analytical approach. The composite operator benefits immensely from this slow, high-volume process. By keeping the price range tight, they prevent retail traders from realizing that the trend is actually faltering. The public sees only high volume, which they often interpret as renewed institutional commitment to the upside. This misinterpretation provides the perfect cover for the composite operator to liquidate millions of shares unnoticed. To spot the wall of absorption, we must become meticulous detectives, focusing equally on the price spread and the volume signature. The first key characteristic lies in the price spread analysis within the absorption zone itself. We are looking for bars or candles that exhibit consistently narrow spreads, especially when compared to the bars that led into the high. These narrow ranges indicate that momentum has died completely, and every attempt by buyers to push the price higher is immediately contained. The daily candles often close near the middle of their range, signaling true indecision. But this indecision is fueled by immense professional activity. A close near the middle shows a perfect balance between incoming demand and the overwhelming structured supply being met by the composite operator. We also observe repeated tests of a critical high or resistance level. The market might thrust slightly above the previous peak, only to immediately snap back into the tight trading range. These failed breakouts are crucial because they confirm that supply is firmly planted just above the resistance line, waiting to absorb any remaining aggressive buying. The price simply cannot sustain the breakout effort. The volume analysis component is the indispensable fuel that confirms the wall's professional nature. Absorption must be accompanied by ultra-high volume, significantly higher than the average volume seen during the preceding uptrend. This volume spike confirms that the market action is not just noise or retail exhaustion. It verifies the presence of large-scale professional interests trading against the prevailing trend. Often the volume will spike to climax levels, especially on the attempts to break the high. This is the moment when the composite operator makes their largest sales, capitalizing on the psychological trigger of the perceived breakout. The high volume on these narrow spread bars confirms that supply is successfully meeting all available demand precisely at that new high price point. The effort is maximized, but the result is minimal. When studying the chart, compare the volume of a recent narrow range bar near the peak to the volume of a wide range bar from the middle of the trend. If the narrow range bar has equal or greater volume, it is a definitive sign of absorption and weakness. The market is effectively stuck in quicksand, expending massive effort only to sink further into the distribution zone. This visual comparison provides irrefutable evidence of Wyckoff's second law failure. The duration of the absorption phase is also important. It is rarely a single-day event. The wall often manifests as a cluster or shelf of high-volume, narrow-range days, spanning several weeks or even months in longer time frames. This duration is necessary for the composite operator to fully complete their distribution without destabilizing the market prematurely. Patience is the hallmark of professional distribution. In essence, the wall transforms the market from a trending environment into a trading range environment, but one characterized by hidden, intense internal selling. The price action becomes choppy, overlapping, and directionless, contrasting sharply with the smooth, easy gains of the preceding markup phase. This change in market character is the first psychological warning sign for Wyckoff practitioners. The tight ranges also often result in overlapping bars, where the high of one day is lower than the high of the previous day, or the low of one day is higher than the low of the previous day. This overlapping price action further emphasizes the lack of clear directional momentum, locking the price into a narrow corridor of intense fighting. The battle between professional supply and retail demand is perfectly balanced. Wyckoff taught that volume is the steam that powers the engine, and the price spread is the distance traveled. If you pour maximum steam into the engine, but the train only inches forward, you know there is tremendous resistance on the tracks. That resistance is the composite operator's supply, building the wall of absorption. The chart patterns we are discussing are not modern inventions. They are timeless reflections of human psychology and institutional behavior. Richard Wyckoff's work provided the framework for understanding market manipulation long before the advent of computerized trading. His insights into the composite operator are as relevant today as they were a century ago. Understanding the historical context of these market movements can significantly deepen your analytical edge. We are focused here on Wyckoff's practical analysis, but the history of how these events play out on a grand scale is equally fascinating. If you find yourself drawn to the historical narratives that shape today's markets, the great panics, the legendary figures, and the monumental financial crises, then you need to check out our sister channel, Wall Street Memoirs. That channel dives deep into the historical events, the financial crises, and the remarkable figures who built and broke the markets of the past. Learning about the great distribution campaigns of Jesse Livermore or the market cornering attempts of the early 20th century provides essential context for Wyckoff's principles. You will discover the foundational stories that explain why absorption always precedes a major crash. It gives you a broader perspective on how the principles of supply and demand and the actions of the composite operator have remained unchanged for over 100 years, despite technological advances. Find the link to Wall Street Memoirs in the description below, and subscribe to expand your financial history knowledge. The wall of absorption is only meaningful as a trend killer when it occurs in the proper context, specifically after a prolonged, mature uptrend. If high volume and narrow range occur early in a markup phase, it might simply be a temporary hesitation or a minor reaccumulation. The power of the absorption signal is derived from its location on the overall Wyckoff schematic, confirming trend exhaustion. We must look for the wall to appear during the distribution phase, which is the institutional process of liquidating long positions. The distribution schematic is broken down into various phases, and the wall of absorption can appear prominently in Phase A, Phase B, and Phase C, signaling different stages of the composite operator's campaign. Each appearance serves a unique strategic purpose. In Phase A, the wall often manifests as preliminary supply. This is the first significant heavy volume bar that appears after a substantial run-up, indicating that professional supply is entering the market for the first time. The preliminary supply bar itself might have a wide spread, but the subsequent trading days immediately following it often show the tight, high-volume characteristics of absorption. This initial absorption confirms that the selling is serious and not just temporary profit-taking. The most intense and dramatic form of the wall appears during the buying climax. The buying climax is the point of maximum retail euphoria, where the public rushes in to buy, believing the price will never stop rising. This results in an overwhelming wave of demand, which the composite operator uses as the perfect cover to offload the bulk of their position. The buying climax bar itself is often a high-volume, widespread bar, signaling the exhaustion of demand, but it is immediately followed by the distinct, tight, high-volume absorption range. The high of the buying climax establishes the resistance ceiling that the market will struggle to overcome for the entire duration of the distribution schematic. The high volume in the subsequent narrow range bars confirms the composite operator is actively absorbing the tail end of the buying climax demand. If the market manages to rally back toward the buying climax high, the absorption characteristics reappear with vengeance. Every subsequent test of that high will likely show narrow range and high volume, reinforcing the existence of the supply wall. This repeated failure to exceed the high confirms that the composite operator is diligently defending their distribution price level. The automatic rally, which follows the buying climax, sets the lower boundary of the trading range, defining the battleground for the absorption process. Moving into Phase B, the wall of absorption often forms the entire structural ceiling of the distribution trading range. The price may oscillate up and down, but every time it approaches the resistance established by the buying climax, the volume increases while the price spread tightens. This continuous absorption acts as a protective shield for the composite operator, preventing a true breakout while they systematically continue to sell. The accumulation of volume within this tight range is what Wyckoff used for his horizontal point and figure counts. The wider the wall of absorption, the more stock the composite operator has distributed, and consequently, the greater the projected downside move will be once the distribution is complete. The absorption zone is the cause, and the subsequent markdown is the inevitable effect. The most decisive and final appearance of the wall of absorption occurs in Phase C, specifically during the upthrust after distribution. This is arguably the most dangerous and deceptive manifestation of the wall for inexperienced traders. The upthrust after distribution is designed to trap late buyers and destroy the positions of short sellers who used tight stop losses. The price briefly thrusts higher, decisively breaking above the established resistance of the trading range, seemingly confirming a renewed uptrend. However, the resulting bar that forms the upthrust after distribution shows high volume and a rapid failure to hold the high. The candle often closes significantly lower than its peak, sometimes even below the range resistance line. This short-lived thrust confirms that the composite operator has successfully absorbed the remaining pockets of demand that were still holding out above the range. The high volume on the upthrust after distribution bar, coupled with the narrow range from peak to close, provides the final, undeniable proof that distribution is complete. The wall has been successfully used to liquidate every last share the composite operator intended to sell. The failure of the upthrust after distribution is crucial because it signals the exhaustion of all remaining demand at elevated prices. It is the composite operator's final trap, often resulting in swift and severe downward movement shortly thereafter. Recognizing the high volume and failed continuation after the breakout is key to identifying the wall in this crucial Phase C context. In summary of the contextual placement, the wall of absorption is the physical manifestation of distribution. Whether it appears as preliminary supply, defines the buying climax, anchors the trading range in Phase B, or creates the final upthrust after distribution in Phase C, its function remains the same. High effort, zero result, confirming professional selling. Traders must train their eyes to see volume not as a sign of strength near the highs, but as a sign of imminent danger when price progress stalls. While the wall of absorption strongly indicates weakness, Wyckoff emphasized the need for confirmation before executing a trading decision. Absorption alone suggests the trend is weak, but it does not guarantee the immediate start of a markdown phase. Confirmation is required to validate the composite operator's successful transition from distribution to the active markdown. The definitive confirmation signal is the sign of weakness. This is the required break below the critical support level of the established trading range. Typically, this support is defined by the low of the automatic rally or the lower boundary of the Phase B consolidation. A sign of weakness must occur on significantly increased volume and result in a wide price spread, confirming the shift in momentum. The sign of weakness confirms that the composite operator has successfully completed their distribution campaign and is no longer supporting the price at the lower end of the range. The market is now free to fall under the weight of the supply that was absorbed at the top. This break often marks the transition from Phase D to the final markdown phase, Phase E. After the wall is established and the price has begun to fall with a sign of weakness, Wyckoff looked for a subsequent rally attempt that fails on low volume. This crucial event is simply called the test. The test confirms the market's underlying weakness by showing that when the price attempts to retrace back toward the absorption zone, there is no corresponding demand to support the rally. A successful test on low volume confirms that the supply that created the wall has fully dried up the remaining demand. This low-volume bounce failure is often the safest and most reliable point for initiating a short position, as it proves the path of least resistance is now definitively downward. The test confirms the absence of the buyers who previously attempted to push the price through the wall. Finally, Wyckoff utilized the accumulation or distribution zone, the wall itself, to project the minimum required downside target using point and figure analysis. The horizontal count rule, developed by Wyckoff, measures the width of the absorption zone in terms of the number of columns traded. This width, when multiplied by the box size and applied to the appropriate scale, provides a quantitative target for the subsequent markdown. The ability to project targets based on the absorption zone provides the trader with both a strategic goal and a measure of the market's potential. A very wide wall of absorption suggests a substantial amount of stock was liquidated, thus projecting a significant drop. This quantitative analysis removes guesswork and anchors the trading strategy in the effort and result displayed during the distribution process. We have covered the intricate details of Wyckoff's most powerful reversal signal, moving from the foundational law of effort versus result to the practical application of confirmation signals. The principles Wyckoff developed are timeless because they are rooted in the unchanging psychology of the market and the actions of large institutional players. They provide a framework for navigating the most deceptive phases of the market cycle. To truly master these concepts and integrate them into your daily trading decisions, a deeper study of Richard Wyckoff's original work is essential. His teachings offer unparalleled clarity on how to read the market's internal dynamics. Understanding how to identify the composite operator's intentions is the single greatest edge a trader can possess against the general public. For those serious about elevating their market understanding, we highly recommend the adapted edition of Wyckoff's classic work, How I Trade and Invest in Stocks and Bonds. This modernized text reveals his time-tested methods for market analysis, clearly defining how to recognize the intentions of the large players and make truly informed trading decisions. This book offers a comprehensive guide to applying the very principles we discussed today, ensuring you can move from theory to practical application. It is an indispensable resource for anyone dedicated to professional trading. Secure your copy today and begin mastering the methods of one of the greatest market analysts in history. The link is conveniently placed in the description below. Remember, the market is a perpetual battle between supply and demand, and the wall of absorption is the definitive proof that supply has won the war. Study these chart characteristics diligently, focusing on the relationship between volume and price spread, and you will gain an indispensable advantage. We look forward to seeing you in the next analysis.